Observe this chilling reality. American households are currently grappling with an unprecedented $1.13 trillion in credit card debt. That figure, as reported by the Federal Reserve Bank of New York for the fourth quarter of 2023, isn't merely a statistic. It represents a towering financial burden, a silent crisis slowly crushing the aspirations of millions, particularly those in the working class. This isn't just about overspending. It's about a system that often ensnares individuals through economic necessity and then profits handsomely from their struggle. This is the financial reality, and today we're uncovering the credit card trap, how you're losing the debt game. The current economic climate has placed immense pressure on the average American household. Inflation, as consistently tracked by the Bureau of Labor Statistics, has significantly outpaced wage growth for many. The cost of essential goods, food, housing, fuel, has soared, leaving little margin for error or emergency. For a substantial portion of the population, particularly those earning below the national median household income, which stood at $74,580 in 2022, according to the U.S. Census Bureau, credit cards have ceased to be a convenience and have become a vital, albeit precarious, lifeline. They're not being used for luxury holidays. They are funding groceries, medical bills, car repairs, and other unavoidable expenses when income simply doesn't stretch far enough. This isn't a failure of personal responsibility in isolation. It's a symptom of a broader economic squeeze. Now, let's delve into the mechanics of this trap. The average credit card annual percentage rate, or APR, has reached staggering heights. The Federal Reserve's data indicates that for accounts assessed interest, the average APR stands at a formidable 22.75% as of February 2024. Let's consider a practical example. Imagine a working-class individual with an outstanding credit card balance of $5,000. At a 22.75% APR, simply making the minimum payment, often just 1% to 3% of the balance plus interest, means that the vast majority of each payment goes directly towards interest charges, with very little applied to the principal. On a $5,000 balance, a minimum payment might be around $100. With an interest accumulation of nearly $95 in the first month alone, a mere $5 would go towards reducing the original debt. At this rate, it would take decades to pay off the balance, and the total cost would be well over double the original sum. This isn't merely expensive, it's an insidious form of financial quicksand, designed to keep individuals perpetually indebted, making lenders extraordinarily wealthy in the process. The implications of this escalating debt are profound and far-reaching. For individuals, being trapped in a cycle of high-interest credit card payments means a perpetually precarious financial standing. It stunts their ability to save, to invest, or to build any semblance of wealth. A poor credit score, a direct consequence of high credit utilization and missed payments, locks them out of better interest rates for mortgages, car loans, and even rental opportunities, further entrenching them in an expensive cycle of borrowing. This has direct consequences for social mobility. The dream of home ownership, for instance, becomes increasingly unattainable when every spare pound is funneled into servicing high-interest debt. On a macro level, this debt burden contributes to widening wealth inequality as the working class struggle to keep their heads above water, while financial institutions report record profits. It also makes the broader economy vulnerable, as consumer spending, which fuels much of economic activity, becomes heavily reliant on borrowing rather than sustainable income. So, what can be done? The first step is awareness. Understand the rules of the game you're playing. Be clear that those minimum payments are a trap, not a solution. Secondly, pursue aggressive debt reduction strategies. Explore debt consolidation options, such as personal loans with lower fixed interest rates, though be cautious to avoid predatory lenders. Budget meticulously. Understand precisely where every penny of your income is going. Where possible, negotiate with your credit card company for a lower interest rate. Many are more willing to cooperate than you might imagine, particularly if you're a long-standing customer. And crucially, commit to financial education. Learn about compound interest, understand credit scores, and grasp the fundamentals of personal finance. This isn't merely advice, it's a call to arms. The system is designed to keep you beholden, but with knowledge and discipline, you can begin to dismantle the chains of debt. Wake up to the financial realities or risk losing the game indefinitely.